Hello, welcome back to Topic Tuesday with Alan Dembski and Juliana Janson from Buffalo First Wealth Management. And today is our final installment on this three-part series of Social Security. As we've been mentioning about that it's not a one-size-fits-all and people should really consider their own options rather than relying on the advice of others. We're going to show you today the examples of early retirement, claiming your full retirement claiming, and then delayed claiming strategies at age 70. So today we're going to jump into some numbers and show you what everything that we've been talking about, what it actually means in a real life example. So I'm going to share my screen again. And here we go. So the real world examples, early versus late claiming, and Juliana's going to jump in and we're going to go through three of these over the next few minutes.
Yeah, so I think we have definitely had clients that have come back to us after they started taking Social Security and said, boy, I didn't realize how little it was going to be. And I think that just comes from not running the numbers and not really getting specific. You can't really go through the Social Security decision exercise adequately if you don't really sit down and run your numbers. So we encouraged that in the last video, and we're just going to stress that again. And by numbers, I mean what your spending is, basically. So, let's say that you've gone through that, you've looked at what your spending is, you know what your spending is. Then the next step is to kind of go through at each different filing age to make your decision. And one thing that I wanted to note that some people don't realize, we talk about age 62 and full retirement age, which is 67 if you're born in 1960 or later, and then again, age 70. The reality of it is you can actually claim anytime in between. After 62, those are not your only choices, but the amount is obviously going to slowly go up with each month that you delay. So sometimes people can't wait till 67, but maybe they can wait till 66 or 66 and a half. The later you wait, the more your benefit is going to be down the line. So for instance, with the age 62 specifically, in this example, James, he's going to be getting $1,400, which is less than his full retirement amount by 30%. So what we've done on these slides is we've kind of looked at, okay, what would his total benefits be, assuming that James lives to the ripe old age of 90. And in this case, he would be getting $470,000 and $470,400. So again, like we talked about in our last video, this is something to think about for somebody that might have some health concerns or have some low longevity numbers for their parents. And the other thing that we mentioned too, when we're talking about longevity, almost every time we sit down with clients, I will ask them, how old were your parents when they passed away? And sometimes people will say, well, they were young. We do always ask if they were smokers, because we all know that smoking affects your longevity. So sometimes if you have a parent that passed away early, but they were a smoker, you kind of have to maybe assume that their longevity would have been longer if they had not been a smoker. So let's say James waits till 67. Instead of getting the $1,400, he's going to get $2,000, which is what we can call his full retirement age FRA amount. And that total is $552,000, assuming that he lives until 90. It's kind of a good middle of the road option sometimes if you don't really want to wait until 70, but you want to maximize, or you want to increase, not maximize, but you want to increase the amount that you're getting. And then, of course, the delayed claim strategy, which is the maximum. Essentially, instead of the $2,000 that he would get for his full retirement amount, he'd get $2,480 each month, his benefits totaling $595,200. Now, one thing that we want to point out here with these amounts, they do not take into account the cost of living adjustments. So if you are delaying your claiming, when you get those cost of living adjustments, they're going to be greater because they're going to be based on a larger initial claiming age. So it's something to take into account. Take these total benefit numbers that we give with a grain of salt, because they're definitely going to be larger with the cost of living adjustments that come through.
And I would say historical increases are anywhere from 2 to 3%. I know a couple of years ago we had a larger one, but that's really not the norm. Again, last year was 2.4, I think, and then this year is projected to be 2.1. So generally over 2%.
Yeah. So, the slide basically talks about the break even point, which is going to give you a little bit more information on, because some people say, well, I'm going to make more money by collecting longer, but it's balanced out by the lower amount that you're going to be getting in
Right.
perpetuity. And that's why the longevity and the health concerns play such a huge role in the decision making in terms of when you want to claim.
And I know this is a generic math equation. 24% from 67 to 70 is roughly 8% increase per year without inflation increases. So if 8% a year is a very good return on your Social Security going forward. And again, it could be more as well.
Yeah. It's hard to get an 8% guarantee anywhere.
Yeah, that's for sure. And being financial advisors and being recorded, we can't say that we're going to give you 8%. That's for sure. But spousal benefits is pretty important because I think a lot of people don't really understand the spousal benefit. Looking at the statements, some people think that you get both when one passes away. Some people think that that's all you get. So if you had a stay-at-home spouse that wasn't high income earner, their Social Security is not going to look as good as the high income earner. But there are some things like the up to 50%. So if I'm at full retirement age, my spouse is at full retirement age, and say my full benefit is $3,000 a month, but then her benefit is only $1,000 a month. Social Security looks at that and then would bump her up another $500 a month to make sure that she's 50% of my benefit at full retirement age. In general, you have to be married for at least 1 year to be able to claim spousal benefits. There's some quirks with spouses that pass away and things like that, and we're not going to get into that today. Or if you got divorced, you have to be married at least 10 years before you can claim on your ex-spouse's Social Security if it's considerably higher going forward.
And I think the thing that a lot of trips people up a lot of times is when you're talking about spousal benefits, it's based on that individual, not necessarily their spouse. So somebody
Right.
might think, well, my spouse is 67, I'm 62, I'm going to claim at 62 and get the full amount, but that is not how it works. You're going to be reduced if you take the spousal at 62, just like you would if it were your benefits that were being reduced.
Right. So as a generic example, I just want to throw this in. So back to my example, the 3,000, 1,500 would be the 50%. So if that spouse was, let's say, 64, that 1,500 would be reduced. Say they get 1,300 for an example. I know it mathematically it does not work out exactly that way, but a cheap generic example, that's kind of how it would work.
Yeah, and I think that a lot of times we do encourage our clients to wait if they can, if it makes sense for them, beyond all the way to 70. But in the case of spousal benefits, that's one instance where you don't get anything additional by waiting beyond your full retirement age. Spousal benefits max out at your full retirement age, which in our examples that we're talking about here, somebody born 1960 or later is 67. So if you're going to take spousal, you might as well just take it at 67 because it's not going to increase by waiting till 70.
And what happens if I die? Do we get both? I know we touched on this before, but we want to stress it again with spousal benefits.
Yeah, no, you're just going to get the larger of the two. So if you're receiving spousal benefits and your spouse passes away, your benefits will revert to just your spouse's, and then your spousal benefits go away. So it is a really important point, and it does trip people up because they do their planning assuming that they're going to be getting both Social Security amounts in
Mm-hmm.
perpetuity, and that's unfortunately not how it works.
Right. I just wanted to throw that in. I know we talked about it before, but it's very important for people to understand. It's you don't get two if only one is still here.
Super important.
And quickly, what you need to do, what you need document wise to apply is personal identification, photo ID, driver's license, citizenship, employment history, and banking information where you want that money deposited. The one thing I will say on employment history, though, list of your employers for the last 3 years, possible W-2s and tax returns. The thing I always tell people, younger people too, even before your Social Security age, is log on to SSA.gov and look at what your earning history was previously. There have been mistakes made in reporting where it's easier to work on that stuff before you're ready to apply, so you're not delaying months or even a year by the time you get records and go back through and create IDs on the government's websites and everything else. The process starts early when getting ready to apply for Social Security.
Yeah. And also a little side note from a fraud perspective, it's nice to have your email associated with your Social Security number so that you'll get notified. And there have been fraud instances where people try to link a person's Social Security number to a fraudulent email. You'll avoid that if you set up your SSA.gov. So it's the sooner the better. I completely agree.
And don't use a work email, because if you leave that job, you will have no way to reset your password.
That is a great point, actually. A great point.
So here are some action items that you can take to help you prepare to claim for Social Security.
Yeah, and I think, a lot of people, it's complicated. There's a lot to it, and it is an important decision to make. So, if you're wondering what can I do, and some of this applies no matter what your age is. The first thing that Alan just mentioned is set up your SSA.gov. That applies if you're 30 or if you're 65. And by doing that, you're going to have all the information at your fingertips to determine what your optimal filing strategy is. First of all, figure out what your full retirement age is. That's pretty easy. And then try to start getting into the scenarios of the early versus late, considering all the issues that we talked about around health history and your own personal family longevity. And then this is my drumbeat. I cannot stress enough really trying to get a handle on what your financial needs are. What's your spending level? And I would also encourage people not to just look at 1 month. If you can look at a year, that's the best, because people's spending really varies pretty dramatically from month to month. So the more data you have, the more confident you're going to be when you go into the decision of actually deciding to take Social Security. And the required documents that Alan just mentioned, obviously your Social Security card and your birth certificate, your photo ID, and all the information that he just mentioned. We just recently had a client say, I'm ready to take Social Security. What should I do? And they asked whether or not we would recommend going in person or doing it over the phone. You can do it online. Those are all three of your options. My recommendation is, I think this is one time where going in person might be the better option. I think that the clients that we've talked to say that they have better luck actually making an appointment and going in and seeing somebody in person. And you can schedule the appointment at the Social Security office, so you don't have to feel like you have to sit there and wait for hours and hours and hours. And you can also, just so that when you do get ready to apply, you can submit your application 3 months before you're actually ready to pull the trigger on a specific start date for benefits.
Right. So I think in closing, determining your optimal filing strategy is all the reasons that we've been mentioning in these last 3 videos to really make the best financial decision for yourself. And again, we've said it a million times already, is making that decision for you and your family, not what my neighbor did, not what my coworker did, or not what the person at the grocery store told me to do. So I hope this 3-part series helps in answering some Social Security questions. And again, we're here to help. You can reach us at info@buffalofirstlllc.com. You can email us personally, go to our website at www.buffalofirstlllc.com. to schedule an appointment with one of the advisors, whether it's Juliana, myself, and our other team here at Buffalo First. So thank you. Hopefully you got something out of it, and stay tuned for our next webinar.